And if you've heard of socially responsible investing, it's similar to that, but ESG differs from ethical or socially responsible investing because socially responsible investing basically says, I'm opposed to guns, I'm not going to invest in firearms manufacturers. Whereas ESG says that you're recognizing that the management of a company or the sector or the industry it's in, these all have direct effects on the performance of a company. So maybe in addition to not morally wanting to support that company or that industry, you also just don't think it's going to be a sound investment.
All right, I want to start off with a surprising statistic. It's always fun to start with one of those. So in Q2 2020, the Q1 inflow into ESG was $10 billion. This is really surprising to put it in context with other asset flows in Q1 2020. And just actually like pretty much year to date with equity, there's been a fairly large outflow, about 240 billion for the first half of the year. And when we think about that in context with ESG, if there's a large outflow in equity in general, but there's inflow into ESG investments, in a time where it's a very turbulent market, this is fascinating as an investor, where people are putting their money in and they're doubling down and they're staying committed to the ESG sentiment, even when there's concerns with long-term sustainability of some companies. So I think this alone is enough to get us excited and starting to think about why ESG is really important to look at. Something else that's just interesting to note is the speed at which money is going into ESG. And so if we look at the numbers from September 2019 to May 2020, it's about a 30% annualized growth rate, which is really quite strong for any sort of fund flow, and specifically for ESG. And this is a number that's not out of the ordinary for a given period looking at ESG, and something we've seen definitely over the past 6 or 7 years has been pretty consistently strong. So now, before we get into the rest of the presentation, I want to offer a little motivation on why we want to look at ESG. And these are 4 companies on the screen, which come from vastly different backgrounds, and they're not all concentrated in one area, but they all have really interesting stories to tell from the ESG perspective. And really, we want to focus today on how does ESG reduce risk? And each of these stories has a definite case example of where an ESG analyst could have looked at the company and realized some components of the company that were not as sound as maybe the financials have suggested, and could have prevented some very serious downside risk. And in investors, we tend to have more aversion to downside than upside. And so that's definitely one reason why we want to look at the ESG component of companies. So I want to start with everybody's favorite co-working company, the We Company. And this was really a crown jewel of the venture capital world, definitely taken in by SoftBank. And it was really thought to be something that would join the S&P 500 pretty quickly. And when they filed for the S1, it became pretty alarming that the company was using valuation metrics that were pretty skewed. And they introduced this concept of community adjusted EBITDA, which from a finance perspective doesn't make a lot of sense. And as investors looked more and more into the S1, they realized there wasn't going to be a lot of interest from the public to invest in this company. And that forced SoftBank to take it off of their IPO track. And it cost SoftBank quite a bit of money. And looking at the company and thinking at it from an ESG lens, before it even got to the S1, there were cracks that were already starting to show. Looking at the management of the company, and specifically Adam Neumann, the CEO, was acting in a way that was more focused on his well-being than the company's well-being or the shareholders' well-being. Adam was doing things like selling the company the We. As the company switched from the WeWorks to the We Company, Adam owned the copyright for the We Company, and he charged the company $5.9 million in stock rights to have that. Further, Adam would often sell the company properties that he owned to make more money. And finally, Adam would even demand that his shares had more voting rights, actually 20 times more voting rights than a common share. And this really speaks loudly to the governance issues that exist inside of WeWorks and how there were problems in the way that the management, and especially the leadership, was acting that might not have been in line with the shareholders' best interest, that might not have been exactly present just looking at the financials during those periods. And this is just an example of how the governance might have been skewed, but we can do the same analysis for the environment or the social aspects of WeWorks. WeWork had a lot of cash to burn through, and they were really not conscious with their use of heat or electricity. And they hired almost exclusively young people, so they didn't understand the toxic work culture that exists inside of WeWorks. This is really concerning, and using some of these more in-depth analysis tools when we value companies could have prevented someone investing in WeWorks and prevented it from getting to such an absurd point where the valuation drops an enormous amount. Another example I want to look at is Wells Fargo. Another case example where poor governance and poor social momentum inside the company caused very severe dislocation of the stock price. From 2002 to 2016, Wells Fargo was famously issuing cross-selling products, which was effectively opening up fake bank accounts and fake credit cards for customers who didn't want them or didn't even know they existed. This really came from the management trying to drive profits and drive their employees to sell as many accounts as possible. Management reported that sometimes they would force their employees to open 20 accounts per day, and this led their employees to feeling sick, and actually led to one employee drinking hand sanitizer to cope with some of the stresses. And the cross-selling that Wells Fargo was doing was not something that was kept under wraps within just the management. At most investor seminars and in earnings calls, Wells Fargo was very open about what they were doing with their cross-selling, although it might not have been so direct what they were doing, but it was clear that they were doing something outside the norm of anything in the banking industry and was very concerning. And looking at the culture and reading more about how employees were resonating with Wells Fargo at the time could suggest that looking at the ESG perspective could have foreseen this problem. And although Wells Fargo was forced to pay a fine, there's still lingering effects from their poor governance. If we look at the 2020 coronavirus crisis, the PPP that banks issued to small businesses was restricted for Wells Fargo, where other banks, it was not restricted. And this was an extremely lucrative opportunity for banks that Wells Fargo missed out on because of their poor governance.
So like Matt said, ESG analysis often can act as a predecessor for structural issues that exist within a company. And then that can be used to mitigate risk if those issues are identified before an event such as the downturn of the stock. For example, or in the example of Enron, pretty much downturn of the entire company. So Enron's a pretty classic example of this. So despite extreme optimism from investors and the public who are pouring money into Enron during its final few years of operation, Enron's audit reports did not exactly tell this same story. In the audit reports reported about Enron, poor operating results as a result of unsuccessful business expansionary efforts were outlined in pretty detailed effect. And despite this, the public, investors, and the media really did not focus on this. It's also important to note that in Enron's final year of final year of operation, employee communications decreased by almost 50%. And this was measured after the fact by looking at average memo lengths and average email lengths. And I think this just underlines the lack of employee communication and transparency in their final year of operation. So had an ESG analyst looked at this company prior to their demise and recognized the failure to expand correctly and the failure to have profitable operating metrics, this risk may have been able to be mitigated, as the company could have realized that despite the extreme sentiment around the stock, there may not be necessarily reasons to actually buy into the valuation. Moving on, another example of this is PG&E. And this is a little bit similar to Wells Fargo in the fact that decisions PG&E made a long time ago are still affecting the stock price and operations today. So in the example of PG&E, they supply power to such a wide array of climates, regions, and people. And because of this, its territory is huge. And there's a tremendous amount of complexity and challenges associated with providing power to such a diverse set of customers. And because of this, looking back 20 years with general trends in climate and population movements, a lot of these challenges could have been identified a long time ago. However, in the last 20 years, PG&E has very little to show that they were actually attempting to form committees and open offices and form boards to mitigate many of the issues that have caused them to, in the recent years, have to run rolling outages. And a lot of items like rolling outages, while unavoidable in the short term, could have been avoided had the company identified and then fixed issues that were pretty clearly, obviously identifiable in the years coming in the last 10 or 20 years. So for example, had an ESG board been established within PG&E, they could have identified some of these issues and then mitigated them entirely. Or as an investor point of view, you could have realized that PG&E was not doing anything over many years to solve these issues, and then consequently chosen to put your money elsewhere. So I think it's just another example of how an ESG analysis can help both the company and the investor mitigate downside risk potential.
So Matt kind of talked about fund flows already, but there's some super interesting trends where you see an increase in the importance and the emphasis on ESG investing sort of as time goes along. And this is sort of intuitive if you just think about your conversations with people in your life. Sort of in general, newer generations are tending to be more liberal than the older ones. So you definitely are seeing you're seeing some tremendous inflows into ESG as money is moving from the boomers into Gen X and the millennials, and you're going to see most likely an even greater growth of ESG as wealth is inherited and built up by Gen Zers. So when I'm doing an ESG analysis, I use the 37 MSCI criteria that's just listed out, and it's broken up into ESG with categories, and then each of these sort of like talking points for each of the breakdowns. But I think it's really important to note that when I'm doing analysis for, like, say Facebook, I'm not just like Googling like Facebook water stress, because first of all, like, there are 37 of these things, and like it can get quite time consuming. And I also think that you sort of need to think about what's material for the sector, but also for the company. And I think this is what's really crucial when you're integrating an ESG analysis with a fundamental analysis, that you don't want these to be two separate things. You don't want ESG to feel like it's an extra step in the process, that you really want this to be like a holistic view of company. So for example, sort of building off of the Facebook thing that I mentioned, if I were looking into its environmental information, first thing I might do is I would research carbon emissions for its data centers, which is basically where they house these massive servers to run their systems. And they're extremely carbon pulling. They're very bad for the environment. And so if I were to look this up, I would find that Facebook constructs a renewable energy plant next to its data center, and it uses this renewable energy to power the data data center, sorry. So that would show like forethought on Facebook's part, and investment in this expensive infrastructure that in the long run is going to be better for the environment and better for the company. But if I were to dig a little deeper, I'd also find that Facebook is offsetting its carbon offsets just in like its office buildings and with employee commuting and things like that by buying carbon offsets, which was essentially like building a power plant or buying a power plant or buying a forest. And it's basically like it's essentially offsetting your emissions. So instead of doing direct things like in your office building to maybe like build solar panels, you're just buying a forest, and you're like, they cancel each other out, it's good enough. And so this would kind of speak to maybe some of Facebook's like deeper business ethics, that these maybe like, or environmental criteria maybe isn't on the top of their mind. Similarly, if I were doing looking into social information for Novartis, which is a Swiss pharmaceutical company, the first thing I would look up, which is sort of just across the board, what sort of my go-to for any company, is its human capital development, which is basically how much does a company invest in its employees. So sort of doing this research, I could find that Novartis's voluntary turnover rate, so like quitting, leaving, whatever, is 7%. And for context, pharma companies can see 15 to 20% voluntary turnover. So the fact that Novartis can hold on to employees like this definitely indicates high employee satisfaction in the company. You can also find data that like 55% of Novartis's hires are internal, which means that Novartis is promoting its employees as opposed to hiring externally. So it's really committed to the education of its employees. This is furthered by the fact that from 2018 to 2019, Novartis's employee trainings increased by 60%. So every employee got on average almost 40 hours of training, which is an immense amount of training. That's a whole work week of training. In addition, there are very few like major drug scandals that mar their record. So from this information, you can kind of conclude, or at least I personally can conclude, that their social part of ESG is definitely in the right direction, and that they're making some really good headway in this regard. So lastly, if I were looking into corporate governance for Costco, which is an American warehouse wholesaler, it's like BJ's or Sam's Club if you're familiar with those in your areas. The first thing I kind of like to do is I look into their board, and for Costco, I'd find that their board is less than 50% diverse. There's 11 seats on it, and there's one person of color and like a couple women, and the rest are white men. And so this kind of, I'm like, okay, does this like go deeper into the company? So if I look a little deeper, I'd find that while 43% of Costco's total employees are women, only 3% of the executive board are, and only about 30% of low and mid-level employees are mid-level managers, sorry. So then this kind of begs the question, like, is there a gender pay gap? Like how are they treating women as employees? So I'd find Costco UK, they reported their mean gender pay gap was over 20%, which is like a percentage of a man's income to a woman's like paycheck. And so the UK as a whole, for sort of comparison, is 7%. So, and Costco's was 20. So like, obviously there's something going on here with their governance and sort of their valuation of their employees. So from this research, obviously there's a lot more I could look into, but just sort of from this high level, I would probably conclude that Costco definitely has some issues with their corporate governance and that they're probably not really valuing their employees and especially not valuing their female employees. So the question that everybody always wants to ask is, do you have to sacrifice returns if you're going to be an ESG investor? And the short answer is no. There's some really interesting trends with volatility, which I'll discuss on the next slide. But with regards to alpha, this organization called the Principles for Responsible Investment did a really interesting study over 10 years from about 2008 to about 2017-18, where they analyzed the returns of two different types of ESG portfolios against geographic benchmarks in these 4 areas of the world. And they use the MSCI rating system, which ranks a company from 1 to 10 based on a ton of data that they aggregate, where 10 is the best ESG score you can get. And so they had 2 portfolios, 2 strategies, and one was called the momentum strategy, which basically had companies in this portfolio that every year their ESG score increased from the previous year. And then they had what was called the tilt strategy, which was just companies with a high absolute score as it was. And they analyzed the returns of these portfolios against like just index benchmarks for the regions. So they found for the world, the US and Japan, the momentum fund outperformed this broad index. So you can see the numbers here. Unfortunately, for some reason, the report does not actually list the percentage for Japan and Europe, just which strategy was more beneficial. But you see like for the US, like almost 20% as compared to the geographic fund. But then for Europe, which is interesting, the tilt fund actually outperformed the momentum fund, which sort of then begs the question, like culturally, is Europe different? Is Europe doing something different? That it sort of seems like they're already at a point where ESG is already definitely just like a point of discussion, whereas the rest of the world, the US, Japan, whatever, are moving in that direction. So there's definitely some really interesting trends you see in the world here. And I mentioned volatility, and in general, sort of the short answer is you definitely see less volatility with ESG companies in general, mostly because they deal with fewer scandals. So there's less things like rocking their share price and really jarring the company. So this graphic is from MSCI, and the green line are the best ESG companies and the red line are the worst ones. And this measures drawdown incidents. And basically a drawdown is like, if you have a peak, so if you think of share price, you have a peak, and then it starts to decline. So then it's in the trough, and then it's in a drawdown all the way until the point where it exceeds the previous peak. So that's called a drawdown. And you see that the green companies, which are the really good ESG ones, they have fewer drawdown incidences than the red ones. So this is basically just the ESG, really good ESG companies are seeing fewer fluctuations, which like I said, mostly has to do with the fact that they're not dealing with scandals and major things. There are also some really interesting trends you can sort of start to observe during the pandemic. Definitely, I would say personally, this should all kind of be taken with a grain of salt because obviously we're still in the middle of this. It's really hard to sort of do this analysis when you don't have the full picture. So I really think that in a few years, there's going to be some really interesting and robust analysis coming out of this. But just for the time being, you can definitely see there's some trends where you see like ESG funds are returning like greater than the broad market, which is really interesting. You're also seeing exceptional inflows, which Matt already mentioned the 2020 Q1 inflows, but the next page has a graphic that's just like really amazing to look at. And you just see Q1 and you see how much money is flowing into ESG funds, which I think is super amazing. But like I said, like this analysis isn't really going to be complete for a couple of years, but I definitely think you're going to see some major changes in investor sentiment with regards to this pandemic.